Have a limited company and wondering whether you should be paying yourself a salary? Well, in this video, I'll look at all the key points to see whether this is a good idea for you. As a business accountant, my team and I spend all day long helping business owners on their journey, and of course one of the most common questions is, how do I pay myself? Now that is an interesting one that's probably due for another video, but I do want to talk specifically about salary in this video and why it's a really good idea. And I'm going to put some screenshots up as we go just to try and explain a little bit more and help you picture the reasons why you might want to do this, because there's a few really important things to understand, and in a lot of cases the answer is going to be yes. You want to pay yourself some salary. In this video, I'm going to presume you've got a small limited company that you're the owner and the director of, because that's the majority of the situations we see in what we do. There are obviously wider scenarios where this may vary, but for now, that's what we're going to presume. So before we get too deep into this, if you like this video, be sure to click the subscribe button below so you get notified whenever we release another one. So as a director and presumably a shareholder, as we said in this example, you could ask the question, well, can't I just pay dividends? I've heard that's cheaper, I've read that somewhere. And the answer is, in some cases, you might just want to do that. The reason being is that dividends are national insurance free. So generally, it ends up being cheaper to do that. For lots of other reasons that are outside the scope of this video, that tends to be the way that people do it. They tend to, in an ideal situation, you have a little bit of salary for the reasons we're going to cover, and then you have dividends. But in terms of paying all dividends, you might not want to do that because you're going to cause yourself a corporation tax bill you might not necessarily have to have paid, and I'm going to show you that shortly. The key thing with dividends, of course, is you actually have to have profits on paper to make them payable, and I think a lot of people miss that. I see very commonly people have started a limited company themselves, don't have an accountant, don't look at the records recently and regularly, and then they just pay themselves dividends all year, or what they think are dividends, and it gets to the end of the year. They couldn't have been, they actually owe money back to the company, it causes a tax problem, and all these other things outside of it, which could have been avoided just by getting good advice early on. But the main thing for me is that for you to know in this particular video is you'd need profits on paper. So if you're surviving off of money you put in, for example, then it's not going to be a dividend coming out. In fact, it could be what they call a director's loan repayment. There's other things going on. But sometimes you might not want to necessarily pay yourself back the money you put in initially because you're not using all of your tax allowances. So with salary, it's generally a very good idea to pay it. The only time you probably wouldn't pay it, and I think it's worth talking about the scenario where you definitely wouldn't, is if you've already got a full-time job where you're earning over 12,500, then all of your personal allowance, the money that you can earn tax-free as an individual in the UK, is already used up. So paying salary in the company might save 19% corporation tax, as we're about to talk about, but it actually would cost you 20% tax, and then potentially national insurance on top at 12%. So it's really not worth doing in the majority of those situations. So what really you want to be looking at is if you've got income under 12,500 from other sources, it's a really good idea to look at using the salary. So as I mentioned, you get a corporation tax deduction. So at the time of recording this video, the corporation tax, which is the company's tax bill, the tax it pays on its profits, is 19% in the UK. Now, so every time you put your salary through, you're actually reducing your corporation tax, which is great, and you'll see the example of that shortly. So in those scenarios, it's a really good idea. So you can see from the scenario we're putting up now, if you had a general company where you've got some profits there's a little bit of profit at the end of it, and you paid the tax, you can see you pay about £1,200 of corporation tax doing just that. Fine, no problems, you pay it yourself as a dividend, we're going to presume you can at this particular point. Fine, okay, not a problem at all. You can see on one side here that it shows your personal tax situation as well. So if you've got no other income, you can see the dividends, there's no tax, and you get a personal allowance of £12,500 at the time of recording this video, and a dividend allowance where you're allowed dividends of £2,000 tax-free. So with all of those things are covering off the small dividend income, so fine. But what happens then if you switch that and you actually pay salary, you can see that it reduces your corporation tax bill down to none, because it counts as a company bill, a company expense, so it reduces your corporation tax. And as you can see, you're still using up all your personal allowances, so there's no personal tax. So it actually saves £1,200 in just that small scenario of paying a £6,500 salary. So you can see it's quite a big difference. And you might think, well, can't I just put all of my salary through then? And again, for lots of different reasons, the answer will generally be no, it tends not to be a good idea once you really reach certain thresholds. Now that's because of the national insurance that's associated with that as well, once you get over the certain national insurance thresholds. So one of the reasons you might carry on paying salary as well is because you can still pay that without significant profits. So with dividends, you need profits to be able to pay them. With salary, you don't. You need to be careful for a few different reasons, but generally that's possible, and that allows you to continue to get a tax deduction. You might even have made a loss, and then you can bring that tax deduction forward so you don't lose it. So it's a good thing to do. You can't do that with dividends. Now, in terms of the level of what to pay yourself, that's very much determined by your personal situation and how much personal allowances you've got free and those kind of issues. But one thing that's really worth bearing in mind is a level at about, and I'm going to use about £6,300 depending on the year when you're watching this video. That means you're at the lower earnings limit for national insurance. And what that means is you get a qualifying year for state pension. Now you need quite a chunk of those qualifying years for state pension, again, depending on what your age is and when you're watching this video. But it's like a tick in the box each year, and it says, yep, you've got a qualifying year, and eventually that's what your state pension's based on. So paying it out at these minimum levels is a really good idea for state pension. Dividend income will not do that. So that's one of the key things about PAYE or employment income. The other thing, and it's minor, but it's worth bearing in mind, is when you come to get a mortgage or lending and they want to know your income from employment is a far easier thing for lenders to deal with. They will deal with dividends completely fine, that's fine. They tend to average them over a few years and look at them, but at the end of the day, if your company is very small and you just want to get some income on paper started, then getting a PAYE salary, a payroll and employment income, is a good way to just get some figures on there for lending as well. Now, in terms of actually paying it, I think we'll end up doing another video on that, but what you need to understand is there are reports you need to send on or before the pay date for these salaries. So it's possible to have an annual scheme actually for a director where you can just submit one pay run a year that shows you had all that salary, so you work out, say it's 6,300 quid that you wanted, or there's other levels that are quite efficient depending on where you are, and you could put all that through in one go. Personally here we never do that, and the reason is that sometimes things can change during the year and it's nice to flex them around, and actually during coronavirus there were a lot of people that lost out on several reliefs because they were using those types of annual scheme, so I'd always recommend having that done monthly. I think doing it weekly is probably an excessive thing to do, and it's certainly if you outsourced it for someone to do, it's going to cost you more money, so a good monthly salary is good. You can actually submit that for free with HMRC basic tools. I think payroll is one of those areas we see a lot of owners getting messed up with those, so I'd be very careful about doing that yourself, but it is possible. You can also do it for your software. You can do it for if you've got Xero or you've got QuickBooks, there's a module there that you can pay for to have access to that, but it is possible for free under HMRC's basic tools. They call it RTI, real-time information, and there's a report and you basically put your details in, click the button, and HMRC get the details. Or of course, you can ask a payroll provider, or many accountants like us do that kind of service. So as you can see, there's quite a few reasons to do that payroll. The main one though being is the corporation tax. The amount of companies that come to us and they say, I've formed a limited company and they haven't done any payroll, it's already too late to fix that problem, and then they're going to have to pay corporation tax that they wouldn't have needed to pay, is unreal. You think for a payroll, depending on the right salary, you could easily save £1,800 of corporation tax. You saw in that little example that I showed you that actually a £6,500 salary saved £1,200 of corporation tax. It's quite a big deal, so definitely think about that. Make sure you're as efficient as you can be and you're not wasting any of your allowances, which could easily be done if you're not getting the right advice. So hopefully you found this video useful. If you have enjoyed it, make sure to subscribe, share it with your networks and anyone else you think needs to know this information, and we'll see you on the next one.